What is going on there today, guys? How are you guys doing? And welcome back again to the channel as always, guys. Okay, so if you've already been investing to the stock market, then I'm pretty sure you've already heard plenty of speculations about a stock market crash coming soon, right? And with the market going its longest on a bull market right now so far, it's no surprise that most investors are predicting one within a certain year or two or so. Now, based on past historical events, most people say around every 8 to 10 years a stock market crash happens. But we can't see the future, guys, so to really determine that off past data or whatever, it's not a guarantee. For all we know, a stock market crash could happen in the next year, 5 years, maybe a whole another 10 years for all we know. So best we can do right now at the moment is just sit back and just see what goes on. But in today's video, we're not going to talk about if a stock market crash will occur or not. We'll leave that for another video in the future, if one hasn't already happened, that is. But instead, what we're going to discuss on today is what exactly is a stock market crash and what causes it and what could result because of it. So this will be just a quick summary video real quick on a stock market crash, nothing too long, so just sit back and enjoy. So what exactly is a stock market crash? Well, it's basically when a stock index drops severely in a day or two of trading. Indexes such as the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. Now, a few common factors about a stock market crash is that it's more sudden compared to a correction. And if you know what a correction is, then I will be making a video on that later on, maybe next week or so. So be sure to stay tuned for that video. And after that, we'll discuss what's the major differences between the two. But for now, we're just going to stick to a stock market crash at the moment, alright? But essentially, it's when the market falls 10% from its 52-week high over a few days, weeks, or even months. And really, the main factor about a stock market crash is that they are sudden, violent, and unexpected. So this is why many traders and investors just hate stock market crashes, because they're just very unpredictable. They can happen at any moment. And if your portfolio is not set up in a certain way to defend it against a stock market crash, then your portfolio is going to be taking a really heavy hit around this time. Now, what can actually cause a stock market crash? There's a few different factors that can trigger a stock market crash, and I'm pretty sure we've all seen past stock market crashes in the past before. So what exactly can cause a stock market crash, you might ask? Well, it comes down to many different factors, okay? And really one of the main big ones is really that frightened sellers normally cause a crash. So what do I mean by that exactly? Basically, it just means when an unexpected crisis, event, or just a major catastrophe happens out of nowhere, all these panicked investors just start automatically selling all their shares, causing all the stocks to just go down, like taking a really deep dive, okay? And it's these panicked investors that are selling their stocks that just, make these stocks just go down, like I said. And one great example of this is the market crash of 2008, where the Dow basically fell 777 points on one day. And it was basically the largest point drop in the history of the New York Stock Exchange at that time. And what triggered this stock market crash is basically investors panicked when Congress failed to approve the bank bailout bill. And basically investors were afraid that more financial institutions would suddenly go bankrupt like Lehman Brothers did. So if you haven't heard about this, I would highly suggest doing your research on this, maybe right after this video or so, or during the week or on the weekend if you have the time. And just really study on this, because it's things like this that just cause a massive panic attack, okay? Investors get just really scared. And again, like I mentioned earlier, they just sell their shares, just causing all these prices to drop down in price. Now, generally speaking, also at the same time, a crash can usually occur right after an extended bull market. So like I mentioned earlier in the beginning of the video, we've been in probably the longest bull market in a long time. So it's very common for investors to start speculating on stock market crash happening soon in the near future, because we all know how the old saying goes, guys. What goes up must eventually come down, right? And with an extended bull market, it basically just means that's when stock prices have been driven up to unsustainable levels. Basically, it just means that at this point, with this constant bull market going on, it basically means the price to earnings ratio is higher than historical averages. So in a way, I guess, to really break it down easily, it's more like this, guys. Let's take for a quick example. The new iPhones that just came out right now recently. If people have been hyping them up so much to the point to where they start getting too overhyped, it's going to drive those iPhones from like $1,000 to maybe $1,500. So take a stock, for example. If it's been getting outbought so much to the point where it just keeps getting hyped and hyped, eventually it's going to come crashing down out of nowhere because it's not at the price that it should be worth. Like again, for example, the iPhone. If you start hyping up the new iPhone from 1,000 to 1,500, eventually people are going to realize, oh, whoa, hold on. This iPhone ain't worth 1,500. It should only be worth 1,000, and the prices are going to dramatically go back down like they should. So that's essentially what happens in the stock market crash, okay guys? People just tend to overprice stocks at a certain point. Now, some after effects that can occur during a stock market crash is that it can usually lead to a bear market for a good while. And at the same time, usually bear markets can occur with a recession afterwards. So in a way, stock market crashes can end up leading to recessions right after, okay guys? Now, how can a stock market crash cause a recession? Well, stocks are basically how corporations get money to grow their businesses. So if the stock prices go dramatically down, then these companies have less money to deal with, okay? They have less money to also grow their companies at the same time. So if certain companies don't produce as good as they should, then the next step is to lay off certain workers. And as workers are laid off, that means they're gonna spend even less. And a drop in demand is gonna equal less revenue, meaning these companies are gonna get even less money on top of that. So as this decline continues, the economy contracts, thus creating a recession. And if you look at past stock market crashes, then you can see that they have all basically caused recessions, such as the Great Depression, the 2001 recession, and the Great Recession of 2008. So these are many reasons why people do not like stock market crashes, because it just leads to a whole lot of negativity along the way. Now, there are different ways to protect yourself from a stock market crash and different strategies you can take on. But we're going to discuss that on a different video that I'll make separately just to deeply go in on that video. But anyways guys, for today, that's just going to wrap it up. I hope you guys didn't get a little confused there on what I might have said. And if you did, be sure to leave a comment down below guys. And if you like this video, be sure to give it a like. And if you haven't already, make sure you also subscribe so you can stay notified for more videos on entrepreneurship, finances, stock market, and just all these different types of topics, okay? Anyways, I'm going to let you guys go and I'll see you guys on the next video.